Hello and welcome to this video that discusses very briefly the fundamentals of fixed income investments. In front of you I have a chart of the 10-year Treasury note out of the United States. It's a government bond. And most of the time when you're talking about fixed income, you're talking about bonds or money markets or things like that. Traders typically, they're talking about bonds. They can be governmental bonds. Those are by far the most commonly traded, but there's also corporate bonds depending on how and where you're trading. For example, you can loan money to Coca-Cola. But most people are going to be dealing with government bonds, so that's what this video will look at. The fundamental analysis for government bonds really come down to two things: demand for the bond itself, and of course interest rate expectations. Because a bond, in 10 years, you get the money that you loan the US government plus the interest back. However, bonds tend to be traded much quicker than that. Very few people actually hold on to bonds. Traders almost never do. So with this, you have to look at interest rate expectations or demand, and then it drives prices up or down. As prices go higher, this is a little bit counterintuitive for those of you that trade other instruments, but as prices go higher, interest rates go lower. So, for example, there is more demand. The U.S. government, in this example, has to pay less in interest to attract buyers, and of course, vice versa. Over here, where bonds started to fall rapidly, it was an expectation of less demand, and therefore the U.S. government had to pay more in interest. The interest, of course, doesn't really come into play until the bond expires or matures, in this case, 10 years. But it is basically how traders look at it. It's an up and down type of situation. Fixed income investments tend to be a really good way to start trading because it focuses on so little. The various factors that can move the markets might be like jobs numbers. If jobs numbers are really good out in the U.S., all of a sudden that shows that we're likely to see an increase in interest rates, and bonds don't become or are not as in demand for the short-term traders, for example. There is a whole plethora of things that move these markets, but quite frankly, I would suggest that you need to look at it from a shorter term perspective, and as the health of the economy increases, typically the demand for the bonds fall off. So bonds are thought of quite often as a way to protect yourself from a weaker economy if you go long at that point in time.